Welcome to the introduction on the importance of investing. Investing is crucial for building wealth over time. It allows you to put your money to work, earning returns that outpace inflation. By investing, you can achieve your financial goals, such as buying a home, funding your retirement, or securing your children's education. Starting early is essential, as the power of compounding allows your investments to grow exponentially over time. There are countless investment options available, ranging from individual stocks to bonds to real estate. However, for many investors, the simplicity and effectiveness of index funds and exchange-traded funds, ETFs, make them ideal choices. These investment vehicles offer broad market exposure, diversification, and low costs, making them suitable for both novice and experienced investors. Index funds and ETFs have gained immense popularity in recent years, revolutionizing the way people invest. These funds track specific market indices, such as the S&P 500 or the Nasdaq 100, providing investors with a diversified portfolio of stocks or bonds in a single investment. By investing in these funds, you can participate in the overall market performance without having to select and manage individual securities. In this essay, we will explore the key differences between index funds and ETFs, examining their costs, performance, accessibility, and suitability for different types of investors. By understanding the nuances of each investment vehicle, you can make informed decisions that align with your financial goals and risk tolerance. In our second section, we delve into index funds and their core principles of simplicity and diversification. Index funds are investment funds that passively track a specific market index. This means that the fund's portfolio mirrors the composition of the underlying index, holding the same securities in the same proportions. For example, an S&P 500 index fund will hold all 500 stocks in the S&P 500 index, weighted according to their market capitalization. The primary benefit of index funds is their simplicity. They offer a straightforward way to invest in a diversified portfolio of stocks or bonds without requiring extensive research or active management. By tracking an index funds eliminate the need for stock picking or market timing, which can be challenging and often leads to underperformance. Another key advantage of index funds is their low cost. Because they are passively managed, index funds have lower expense ratios than actively managed funds. Expense ratios represent the annual fees charged by the fund to cover administrative and management costs. Lower expense ratios translate into higher returns for investors over the long term. Index funds provide broad market exposure, allowing investors to participate in the overall growth of the stock market or a specific sector. By holding a diverse basket of securities, index funds mitigate the risk associated with investing in individual stocks. This diversification helps to reduce volatility and protect against losses if a single company or sector performs poorly. In our third section, we discuss exchange-traded funds, known as ETFs, focusing on their flexibility and accessibility. Exchange-traded funds share many similarities with index funds, as they also track specific market indices. However, ETFs differ from index funds in their structure and trading mechanism. ETFs are listed on stock exchanges and trade like individual stocks, allowing investors to buy and sell shares throughout the trading day. One of the main advantages of ETFs is their flexibility. ETFs offer intraday trading, enabling investors to react quickly to market movements and take advantage of short-term opportunities. This flexibility is particularly beneficial for active traders or investors who need to adjust their portfolio allocation frequently. ETFs also provide greater accessibility compared to index funds. Many ETFs have lower investment minimums than index funds, making them accessible to investors with limited capital. Additionally, ETFs can be purchased through brokerage accounts, providing investors with a wide range of choices and the ability to manage their investments alongside other assets. Similar to index funds, ETFs offer diversification and low costs. By tracking an index, ETFs provide exposure to a basket of securities, reducing the risk associated with individual stock selection. ETFs generally have lower expense ratios than actively managed funds, although they may have slightly higher expense ratios than comparable index funds. In our final section, we compare the costs associated with index funds and ETFs, focusing on fees and expense ratios. Cost is a crucial consideration when comparing index funds and ETFs. Both investment vehicles are known for their low costs compared to actively managed funds. However, there are subtle differences in their fee structures that investors should be aware of. Index funds typically have lower expense ratios than ETFs. This is because ETFs incur additional costs associated with trading and market-making activities. Expense ratios represent the annual fees charged by the fund to cover administrative, management, and operating expenses. ETFs, on the other hand, may have lower trading costs than index funds. Index funds are typically bought and sold through mutual fund companies, which may charge transaction fees or commissions. ETFs, being traded on stock exchanges, incur brokerage commissions, which can be lower than mutual fund transaction fees, especially for frequent traders. When comparing costs, it's essential to consider both expense ratios and trading costs. For long-term investors who buy and hold investments for extended periods, the lower expense ratios of index funds may be more advantageous. For active traders who execute frequent trades, the lower trading costs of ETFs could outweigh the slightly higher expense ratios. Section 5. Performance tracking the underlying index. Both index funds and ETFs aim to track the performance of a specific market index. Their success in doing so is measured by their tracking error, which represents the difference between the fund's returns and the index's returns. A lower tracking error indicates a more accurate replication of the index. Index funds and ETFs generally have low tracking errors as they are designed to passively mirror the index's holdings. Factors that can contribute to tracking error include expense ratios, trading costs, and the fund's replication strategy. Expense ratios can impact tracking error as higher fees erode the fund's returns. Similarly, trading costs such as brokerage commissions for ETFs can also contribute to tracking differences. ETFs that employ sampling strategies where they hold a representative sample of the index's securities rather than the entire basket may have slightly higher tracking errors. Overall, both index funds and ETFs have a proven track record of delivering market-like returns. Their passive management approach eliminates the risk of human error and emotional biases that can affect the performance of actively managed funds. By investing in these funds, investors can participate in the long-term growth of the stock market or a specific sector without having to outperform the market. Section 6. Accessibility, trading, and investment minimums. Accessibility refers to the ease with which investors can buy and sell shares of an investment fund. Index funds and ETFs differ in their trading mechanisms and investment minimums, which can impact their accessibility for different types of investors. Index funds are typically bought and sold through mutual fund companies. Investors can purchase shares directly from the fund company or through brokerage accounts that offer access to mutual funds. Index funds often have higher investment minimums than ETFs, which can be a barrier for investors with limited capital. ETFs being listed on stock exchanges are bought and sold through brokerage accounts. Investors can trade ETFs throughout the trading day, just like individual stocks. ETFs generally have lower investment minimums than index funds, making them more accessible to investors with smaller amounts to invest. The choice between index funds and ETFs in terms of accessibility depends on the investor's individual circumstances. Investors with larger sums of money and a long-term investment horizon may find index funds suitable. Investors with limited capital or those who prefer the flexibility of intraday trading may opt for ETFs. Section 7. Real-world examples comparing popular funds. To illustrate the differences between index funds and ETFs, let's consider real-world examples of popular funds tracking the S&P 500 index. The Vanguard 500 Index Fund, also known as VFINX, is one of the largest and oldest index funds tracking the S&P 500. It has an expense ratio of 0.04%, making it one of the most cost-effective options available. VFINX is known for its low tracking error and consistent performance over time. The Schwab Total Stock Market Index, or SWTSX, offers broad exposure to the entire US stock market, including small, mid, and large cap stocks. It has an expense ratio of 0.03%, making it even more cost-effective than VIFIX. WTSX provides investors with a diversified portfolio that captures the overall growth of the stock market. The SPDR S&P 500 ETF, known as SPY, is the largest and most actively traded ETF tracking the S&P 500. It has an expense ratio of 0.09%, slightly higher than the index funds mentioned above. SPY offers intraday trading and lower investment minimums, making it suitable for active traders and investors with limited capital. The iShares Core S&P 500 ETF, or IVV, is another popular option for tracking the S&P 500. It has an expense ratio of 0.03%, comparable to the index funds VIFIX and SWTSX. IVV offers a balance of low costs and trading flexibility, making it a compelling choice for many investors. These examples demonstrate the variety of index funds and ETFs available to investors. Each fund has its own unique characteristics, expense ratios, and trading mechanisms, allowing investors to choose the option that best suits their needs and preferences. Section 8. Conclusion. Choosing the right investment for you. Index funds and ETFs are both valuable investment vehicles that offer diversification, low costs, and market-like returns. They provide investors with a simple and effective way to participate in the long-term growth of the stock market or a specific sector. When choosing between index funds and ETFs, investors should consider their individual circumstances, investment goals, and risk tolerance. Index funds may be more suitable for long-term investors who prioritize low costs and are comfortable with less frequent trading. ETFs, with their intraday trading and lower investment minimums, may be more appealing to active traders and investors with limited capital. Ultimately, the best choice depends on the investor's specific needs and preferences. By understanding the key differences between index funds and ETFs, investors can make informed decisions that align with their financial goals and investment strategy. Both investment vehicles can play a crucial role in building a diversified portfolio and achieving long-term financial success.